Hi, this is Todd Spitzer, and you're watching Eye on Business.
Welcome, my name is Kevin McDonald, and tonight we're recording a show called Eye on Business. Our program runs on the internet at ionbusiness or ionproductions.com, and also runs weekly at 6 a.m. and 6 p.m. on Time Warner Television here in Orange County. Again, we are here tonight at Kenobi, Martins, Olson, and Bear, and we are doing the Tech Coast Venture Network Forum tonight, and a panel on the discussion of the valuation increase in your company without spending more money, or how to increase the valuation spending less. The two gentlemen at the panel today with us are two very well-known serial entrepreneurs and folks that we all want to hear from today. Mr. Stephen Block, who is with Tech Coast Angels and is also a principal at Trenchant
Ventures. We both
Trenchant Ventures, and Mr. J.J. Richa, who is also a principal at Trenchant Ventures and a member of Tech Coast Angels. Welcome, gentlemen.
Thank you. I just got to say, J.J.'s the genius behind Trenchant.
Oh, no, don't say
So, and I'm sorry, we added Mr. Ray Chan, who is also the founder and primary investor in VOKLE, which is the organization that's made it possible for us to run tonight, which is really fascinating for me because this is my first live show. I appreciate that you're all here. So let's start right off with the fact that we all know we're having trouble in this economy. Many small businesses are trying to find a way to get funds.
Can we explain, as I said, Raymond, you may want to do it, or Shant may want to do it, a little bit of explanation of VOKLE and what it is and you know, what its benefits are?
Does Ray have audio?
You have to, yeah, a little bit. You're a little bit soft.
Okay, you want to go ahead and explain?
Steve, do you mind to take over because
Now we can hear you fine. But would you? Go ahead.
Well, can you? Okay. So VOKLE is a live. Steve, I think you better take over because I'm hearing echo from my side.
You are? We're not hearing you in echo at all, but that's all right. Let me tell you about VOKLE, a little bit about VOKLE.
Ray, if you want, just lower your speaker volume so that way you won't be able to hear yourself.
Are you talking to us? Or
yeah, it's really loud. I can hear the feedback too.
Oh, Raymond.
It's real nice that we get to edit ours for the TV, so I'm not worried.
You want to try it again, Ray?
Ray, just go ahead and speak for a little bit, and you know, don't.
We'll get to the substance.
Go ahead, guys. I'm going to tell on my side.
I think it'd be better.
Go ahead, Ray. Oh,
He's
lost
gone.
him.
Maybe Shant wants to take that. Yeah. Okay.
Shant,
Go ahead.
Okay.
Shant, you want to tell us
if
a
you
little
want,
bit about VOKLE? Yeah,
I'll be able to explain VOKLE.
Yeah, go ahead.
If you want, I'm going to take my earbuds out because I can hear myself. So if you want, I can explain it.
Go ahead.
Go for it.
Okay,
Go for
Shant,
it.
so go
Yes.
for it.
Okay.
First of all, who are you?
Okay, cool. So, yeah, basically VOKLE is a live video town hall platform for people to broadcast on and actually take live video questions from the audience. So if you're a host, you can actually interact with your community live. And that's pretty much it. You can also take text questions and the ability to also assign multiple roles in your event. So for example, if you want, if you're having like a Michelle Obama event and you don't want anyone to just call in, you can basically assign screeners where basically they would screen the video callers behind the scenes one-on-one just to make sure that their technicals are all set up and things like that. So you can have screening. You can also have someone to edit the event, just like whoever did that right now. So you can basically cut between the shots. So that's editing, screening, a co-host who is someone who basically broadcasts the event with you. And that's pretty much it. It's kind of your own communications platform. And you can also embed it on your website. So just like YouTube, one line of code, copy and paste. And
it has a lot of applicability in the political arena. It also may have some significant applicability in the entertainment arena.
Great job. That was great. Thanks, Sean.
What? Sorry? You talking to me?
No, go ahead.
Where entertainers can, for example, interact with their fans, may even have online concerts which they can charge for. So it's really a very flexible platform, and it's got tremendous potential. It's been funded by a number of investors, Tech Coast Angels being one of them, and I can say I'm an investor. Are you? No. Okay, I've invested. JJ really has, I don't mean JJ. Ray has really invested the most within Tech Coast Angels, and he's, I guess you're the acting COO, Raymond, is that right? He doesn't hear me, it's okay. Yeah, he's the COO of the company. And he's really been the sort of the moving force from a Tech Coast Angel standpoint behind how we have gotten involved in doing this. This is this will be my fourth activity involving VOKLE. I was in the first beta that they did about a month and a half ago, I guess, or 2 months ago, and then over the last 2 Mondays, I was online doing basically what I'm doing tonight, talking to entrepreneurs, answering questions about various aspects of investing through the angel process. And we had a very effective, it's a very effective vehicle. We had a lot of people online. We had a lot of people asking questions by text, which you can do. And we had a lot of people asking by live. And we actually had 3 pitches from entrepreneurs who were seeking funds. So
now that we're done with the commercial, we can move on. We're all here as potential investors and people that are trying to start up businesses and those that are involved with them. We all know that the economy is difficult right now, and the fact is that getting information from folks like this that have the background is a really powerful way for you to learn to not make the same mistakes. It's the old point about those that forget history are bound and determined to repeat it. So let's get right into the subject, and that is, how do you get an increase in valuation and spending less in this market? JJ, I'd like you to start with, how does someone trying to increase their value today with the lack of new IPOs in the United States find high valuation without spending a lot of money?
I think you need to go back to the very basic, and that is having a good team. A good team will increase the valuation. Second is having the right board, the right advisors. If investors or potential acquirers or investment bankers that are going to take you to an IPO, if they see that you have a dynamic team that's worked together before, that had successful ventures before, exits before, and a great advisory board and a great board, that's going to really have a great impact on the evaluation of the company. Now, there are more things, but I'll start with that.
So, Stephen, let me ask you this. How does a startup company that doesn't have any value and doesn't have any money lure good talent?
With equity. I mean, a lot of entrepreneurs use equity, pieces of the company, to attract their team with a promise of cash salary at some point, but often the team will work for months without any pay, just knowing that if they do well, their equity will have significant value in the future. So that's and again, if the idea is good and there's a lot of passion within the team, that's another thing that's important. I mean, the team is good. What JJ said is absolutely right. The team, the board, and the advisors. But there's also a collegiality in the way you work. And that comes through to investors, believe me, and a passion that you show when you meet with investors. A good presentation, for example, is another way to increase your valuation. Anything you can do to impress the potential investor of your intelligence, your worth, will go far to increase your valuation.
So if we're as a group, let's say I'm an investor and I'm thinking, I got this great idea, I'm one person, maybe two or three, I've had some family investment, now it's time to bring in some additional talent that might draw investors like you. How do I go about finding them? I'm not going to put an ad out on the internet, am I?
No, you're not going to put an ad, but you're going to go to people that know the industry well, that can help you penetrate the industry, whatever industry, for the product or service that you're trying to do. As an entrepreneur, you need to attract the right talent for the business. So you start with that, and then you attract the right advisors to help you reach whatever potential you're trying to reach.
So let's cut to the chase then, Stephen. What when you're really looking as an investor, and you have an individual who spent their life or a good portion of it and a lot of money trying to build up an idea, and you're now coming to them and saying it's worth this. What do they have to look forward to in the way of having to show, evidence of value? What are you looking for?
Well, it depends on the stage of the company. If it's a pre-revenue company, it's a little hard to show, anything more than really a proof of concept. It'd be very helpful if you're out there, you've got some. I don't mean traction necessarily, although traction would help. If you've got examples of people who've, as Don likes to say, eaten the dog food, and demonstrate that there's an interest in the concept, that's a very great help. If you have intellectual property, that's also a great help. Some businesses have it and some businesses don't. It's just the nature of the business. Many are what we call execution plays. I'm trying to, but these are the things we look for the team. We look for the space. Are you in a niche? Are you in a unique niche? Are you different? Have you differentiated yourself in your business model, in your revenue model, in the way in which you're going to market, in a way that'll make you stand out from the rest of the people in the industry?
So,
can I add?
Yeah, I was going to say, JJ, I'd like to take that a step further and say, what is a protectable position to you? What do you consider to be something that is of value? Is it a patent? Is it a patent pending? Is it a copyright? What do you believe is?
Well, I guess first I would like to see that a solution is being solved. So there's got to be a problem and a solution. So that's the first thing that I would look for. So if there's a problem and they're solving it in the right way, then this is that increases the value of the company. Second, as far as a patent, sometimes the patent really doesn't help. It's really how fast can you get to the market. The third, to add on Steve's what Steve said, is I think sometimes affiliation with other companies or other partners in the market could actually increase your valuation drastically, because the affiliations with such companies could get you to markets where you could not be able to get to them before.
Let me add to that, because there's one area that's a two-edged sword. And those of you who would like to hear my workshop on strategic collaborations, I'm happy to have you come.
He's an expert.
This concept of partnerships can be a two-edged sword in the long run, particularly, and for investors. If you are a partner, if you've partnered in some way strategically with someone in the industry, and it doesn't necessarily mean that they have to invest in you, but they're your marketing partner, and you guys are doing something together, that's great. It gets you to market faster, it gets you more visibility. But it may also impede competition on your exit, which is the key for an investor. The investor likes to see a business grow and then have a lot of people bidding to buy it, or if it can go public, fine. And when you're in bed with one major partner who's sort of a gorilla in the industry, it sometimes appears to investors that they're going to have the leverage to really dictate the exit terms to you, and you won't have the opportunity, and nobody else in the industry will really come in and bid. So that's a double-edged sword. It can work fine, but it also has that potential negative that you've got to be aware of.
So with that said, let's think about the imbalance sometimes in what you talked about before, which is that you have to have revenue, You prefer market share.
We don't have to have revenue.
Or you prefer revenue. You prefer market share. At what point, and you then mentioned that you want speed to market. At what point does an entrepreneur need to be careful about giving away too much out to that public market and giving away the idea that how they're operating so that they can't beat someone else in the market because someone else with more money may come along and beat them at their own game? Is that something that they have to be concerned about realistically?
I think it depends on the nature of the business. There are a lot of businesses, a lot of space, a lot of verticals, which have a lot of room for new competitors. So it may not be that critical that that people know who you are and you're going out there. If you're in the vanguard of that group is going out there, one of the first, if not the first, and you've got a good product and you've got a good potential, I don't think it's as serious. If on the other hand you're in a crowded space where there are a lot of players already, even if you have something that's unusual, if it's not protectable with intellectual property, which is where the intellectual property comes in much more importantly to me, then anybody can knock you off. And I mean, if there are large companies in this industry or in your industry, then the large companies have a tremendous advantage in resources, both human and financial, to basically do what you're doing and do it even faster and better.
So,
yeah, I think Ray may have a question here. I don't know yet. You might want to ask him. Let's see.
so with that point being made, let's ask the next question, which is, when is it appropriate to bring an investor in or someone to help you potentially sell to a larger company rather than trying to find cash investment, or does that ever make sense?
Well,
Go ahead.
it makes. I mean, it's not in the context of the entrepreneurial. In the entrepreneurial context that we're in, it's very rare that a company will get off the ground without some at least initial investment, whether that's friends and family, whether that's an angel, whether it's some group, something to get some traction. On the other hand, there may be some places where the IP is so obviously tremendous that somebody will come in and try to grab the company. But the problem there is that without proof of concept, without some customers, without some business, the value that somebody is willing to pay is going to be much lower than if you have built something that's larger. On the other hand, you don't have to be that large. And I'll give you an example in a field that I'm pretty familiar with, which is digital media, virtual worlds, kids' virtual worlds. Club Penguin was bought by Disney. They had no profit. It was non-profit. It was unprofitable. And I believe they only had about 700,000 registered users at the time. Now, that sounds like a lot, but in this business where you can grow to tens of millions in a very short time, it was nothing. Yet Disney, I'm going to tell you, Disney paid $350 million to buy Club Penguin, which is not a very good site, by the way. But I'm biased, but we'll talk about that later. It's to buy Club Penguin. Plus, the sellers had an opportunity to earn another $350 million, depending upon the growth of the business over time. Now, that period is gone, and they didn't earn any of that additional $350 million, although Club Penguin is pretty successful for Disney. So it's just being in the right place at the right time to get the maximum value sometimes.
I agree with that.
So let me ask you a question about licensing. To me, it seems sometimes that if you can get a good licensing deal or two, where it shows a recurring revenue stream in agreement with maybe a couple of these large strategic partners, that would be a significant way to increase your valuation, would it not?
Absolutely. First of all, recurring revenue is a major part of I think a large valuation for a business, especially in today's market. Having licensing deals is great for any business to increase their valuation, to increase their revenue. But I want to go back and talk a little bit about what Steve was talking about. I think Steve likes a little bit, or actually he sometimes prefers earlier businesses, you know, a little bit more riskier. Most of the angel investment nowadays is more goes after businesses that have somewhat of a proof of concept, some customers on board. So you don't see any more very seed type deals or early stage, much earlier than the angel investors. Angel investors nowadays are, most of the time, they're not you know, taking as much risk as before, and also, you know, they may be important in valuing the business or helping with additional VC funding, but it's really up to the entrepreneur to find that strategic exit, to go after IPO, whatever it is, and not, and maybe VCs can help with that, but not from the angel side in general.
So a comment.
But the angels can help you get VC money.
Yes, that's
the
very
angels
true.
the angels individually or groups often have very strong contacts and relationships with
VCs. Yeah.
VCs. And if the angel group or the angel individual has credibility with those VCs, a recommendation to that VC is more likely first to get you in the door, to get you heard, and then if you in fact prove out to be what the angel says you are, to get you funded.
So let me ask you a question about the investment that's been made, not just the intellectual investment, but the financial investment by the entrepreneur themselves. I've had conversations with both you gentlemen. In fact, you've been interviewed for my TV show in the past, so I know the answer, but I want to hear it for the audience, and that is, what position do you want most investors in the way of their own debt, their own running of their own credit cards up? I mean, how deep do you want them before you can get them? Right, yeah, the entrepreneur, I'm sorry.
I'd like to see usually, you know, somewhere around, you know, $25,000, $50,000 from an entrepreneur into the business. Well, again, it depends on really many variables, but some skin in the game really proves that the entrepreneur is serious about this business, is ready to do anything possible to do this. So most of the times entrepreneurs come into TechCoast Angels and they present and they say, well, I spent 2 years on this, but I haven't spent any cash. And usually that's not a measure of investing into a business. So there's got to be both cash and sweat equity, both together. So that's kind of really, I'll let Steve continue on this subject.
What I love to say when that question is asked to me, I like to see entrepreneurs who have mortgaged their houses to the hilt, maxed out their credit cards, drawn completely on all their credit lines, and need this money desperately in order to survive, because that shows that they're committed. They may be committable for having done that, but they're committed. So in all seriousness, it's the skin in the game. I mean, that's an extreme example, obviously, but it's the skin in the game is very important, and that skin in the game's got to be cash. The sweat equity just doesn't cut it with angel investors.
Not enough. Yeah. Well, I mean, from a personal experience, I've been to where Steve just explained, under a lot of debt, trying to reach you know, the success in my company, at least in the last company that I had. So and that makes you work harder. It makes the entrepreneur work 24 hours a day in order to reach the success, and that's what the investors are looking for. They're looking for success.
So let's put a little realism into the show here from the perspective of all the people that are out there dreaming. And by the way, I'm juxtaposed completely and absolutely opposed to any dream killers, so don't get me wrong when I ask this question. What is the reality of a valuation of a company that's even in revenue in the beginning? I mean, I hear, we've all heard stories about the napkin that was sold for tens of millions of dollars, and this idea that you just talked about that was sold to Disney for 350, but that's not very realistic. And many times the conflict between the investor's concept and idea of valuation and the entrepreneur's idea are a problem. How do you, or can you help us a little bit in where do you find that balance, and how do you convince that entrepreneur it's not worth $100 million?
Okay, I'll start. most entrepreneurs think that when they're valuing their company, they're valuing the future value of the company, which means that, you know, in 10 years it's going to make $300 million, so it's worth, you know, 900 million today. But that's not the case. The case is, what is it worth today? There is some future value included in the valuation, but most of the valuation is how much traction do you have, how many customers do you have, how much revenue do you have, and then you add some future value on top of that. And if a company is getting funded from a VC or from an angel investor or a potential VC later, then that adds to the success and lessens the risk of such company, which means it increases the value also even more. So and I could tell you an example that happened today. I won't mention the name of the company, but a company is doing about $1 million in revenue today, and they're seeking $500,000, and they on the basis of a $10 million pre-money valuation. Well, there is no basis for that. So this company is in the consumer product business, and if they were to get sold today, it's 1.5 times their revenue.
That was my next question, is what is the X today? It used to be multiples.
Well, it differs by industry.
It depends on the industry. So this specific industry is about 1.5 to 1.8 times. So they're valued at maybe at 1.5 million to 1.8 million. So you figure maybe a future value that adds, you know, maybe $2.5 to $3 million. But it cannot be more than that. And they weren't willing to come down to that, so they probably lost you know, the TechCoast Angel round.
I'm going to say something that's probably heretical. I want to say two things. One is the valuation of a startup company is a matter of negotiation. You can't really put a value on a startup company. You can make all of the arguments you want about traction and customers and IP and so forth. Nobody knows where that company is going to end up. 90 to 95% of companies fail.
That's right.
So therefore, it becomes it's very subjective. We have a guy in TCA who's written a book on valuation. He has a formula that he loves to use. It's fine for him, but to me, it's not realistic. So I take the position that evaluation is a negotiation. But I also want to say something to you guys as entrepreneurs. And this is what I tell every entrepreneur. It doesn't matter what the pre-money, the initial valuation is. If you're going to succeed, you're going to make lots of money. And if you have a high valuation and it goes nowhere, you still have nothing.
You lost it.
So what I tell people is to look at it this way. What would you rather have at the end of the day? Would you rather have 30% of a company that sells for $300 million or 100% of a company that you can only sell for $5 million? Now, too many entrepreneurs are too worried about losing control. That is the thing. And they think control means they have to have a majority of the equity, even a supermajority. It's not true. First of all, I'll tell you right now that angels who invest and they do it and they will impose a lot of conditions on the investment in terms of what the entrepreneur, what the company can do without the consent of the angels. And those things take away from the control. And VCs will do even more. So the more important thing is, what do you think you're going to make on an exit, not how much of the company you're going to own.
So with that said then, if I may ask this on the point you brought up about the valuation, goes back to our original point here, is if it's a negotiation, then would investment in the communication tools, the proper presentation, knowing how to speak of the value of your company, is that where you should be putting your money? Besides, of course, raising real revenue.
I think you got to put, go ahead.
Put it in the team.
Yeah.
Put it in the advisors, in the board. Put it in acquiring customers that are payable customers. That's where you need to put all that. Not well, the presentation is important, but if you don't have any of the other stuff, then there's no point.
unless you're a pre-revenue company. And this is where JJ and I have somewhat of disagreement. And I've got to tell you, I disagree with a lot of, and I'm going to say it, with the notion that angels are only investing in companies that have revenue. That's not true. Angels are investing in companies that are pre-revenue. They may not get the same kinds of valuations, and they may get as much money as somebody who is in revenue. It depends on the space. Frankly, the true angel is the person who invests in the pre-revenue company. And the VC is the next level. And what's happened because of the recession, particularly over the last 4 years, is everybody's moved downstream. So angels, because they're being more risk averse, have moved to what used to be perhaps the early stage VC stage. And VCs, who used to invest in early stage companies, see now that they can get more advanced companies for similar valuations, thereby reducing their risk. Now, whether this is going to come back, I don't know. But it'll be a function. It'll be a long time before it does, if it does. But TCA still does invest in pre-revenue companies. VOKLE is an example. And a company in which JJ invested because I twisted his arm to, the company I co-founded, is another. We are more comfortable if the company has some traction and can demonstrate that it's a proof of concept that people, as I say, as Don says, the dogs are eating the dog food.
So has that movement up the chart diluted the entrepreneur's position at this point then? Because if the valuation is pushed out farther, doesn't that narrow the position of the entrepreneur earlier in the process?
I'm not sure I understand.
Well, if you come in the early, you want to answer the question?
No, go ahead. No, repeat, because I didn't get it either.
Okay. If you are pushing out the investment to the point where only post-revenue companies are getting valuations and they're getting similar valuations to what they were getting when they were pre-revenue, doesn't that dilute the ultimate value of the entrepreneur's position?
But again, like Steve said, at the end of the day, you're looking at the exit. And if you can't get your product or service to the market, you're not going to get anywhere. It doesn't matter what the valuation. If the valuation is 3 million versus 4 million, who cares at this stage? It's not going to make a big difference.
And that was the point I was looking for. I think one of the things that folks need to understand is there are two types of businesses. There are those that are lifestyle businesses that want to just make enough money and keep making it, and then there are those that want to gamble and make it big. And in order to make it big, generally you're not going to do that organically. It does happen occasionally, but most of the time it takes folks like this. And the reason I bring up that dilution is it really doesn't matter because you're diluting something you don't have. So you're better off to accept the expert advice from folks like this and accept some of the dilution. I'm not saying give away your shirt by any manner, but it is important that you listen to them because they want to make money. They have no intention of coming in and working with a company that isn't going to make a profit for them.
Can I make a point here, though? We want you to make money. It's in our interest to make sure that the entrepreneur, if we fund the entrepreneur, that the entrepreneur is sufficiently incentivized to continue with this passion, to continue with this commitment. So nobody's trying to sort of money grab or take advantage of you. What we want to do is something that's fair for everybody, because we know we're going to be dependent upon you to make the money, to build the business in a way that'll make the money for you, but also for us. So there's a balance that's always drawn. And I think Kevin's point or JJ's point is very good. There's no difference between 3 million, 4 million, 2 million, 4 million. I mean, it's irrelevant in the long run. It's just absolutely irrelevant in the long run, and too many entrepreneurs get caught up in that. Now, what happens in some of these cases where the angels may like the deal, but the entrepreneur and the angels don't really reach a meeting of the minds as to the actual valuation? We cheat, and we cheat by using a convertible note. So what we do is we have a convertible note which says that we will convert our note at a discount, usually 25%, to the next round, at the valuation of the next round. Now, there are variations of this which include caps and warrants and so forth. But what we're really saying is we can't value it. Well, let's the VC value it. That's been much more prevalent in the last couple of years because of the crazy economy. So there is hope even if we can't reach valuation agreement.
JJ, I just want, well, what Steve said is true, but what happens is we get crammed down by the VCs and the warrants are gone, and so sometimes. Yeah, but no, I want to say also that the entrepreneur needs to go after smart money. So it can't just be getting any money from anyone, because by receiving investment from TechCoast angels or other investors, these investors are going to have a board seat, which means on their company, which means they will eventually have control, which means they can actually decide on the direction of where this company is going. So it's a marriage between the entrepreneur and the investor. So it needs to be the right money from the right investors, and there's got to be synergy.
So move to the next point, if I may. Both of you are principal partners in Trenchant Ventures, and as I understand it, Trenchant Ventures looks for more distressed organizations. Am I accurate in that?
Yes, correct.
So at this point in the economy, would it be better if a company could continue to roll forward organically, maybe not grow a whole lot, to maintain and hope that we don't hit a double dip, or would you suggest still going after that investment in today's market?
Go after the investment, absolutely.
You can't grow without it, and you know, you guys want to succeed. You got to take the risk. You got to take the gamble. We're taking it when we invested you. We want you to take it too. I think the economy is tough, makes it a harder slog for you and for us, which is one of the reasons that valuations are lower. We look for great entrepreneurs, and great entrepreneurs build great companies. Matter of fact, we've had 3 exits in the last week. Very interesting exits.
One IPO today.
One IPO today, and I think there's another. Well, we're having 2 exits. We had an acquisition where the investors got about 8 times their money back, which is not bad. We like 10 times our money in 3 to 5 years. It doesn't happen, but they got 8 times their money. But the
realistically,
but the IPO that went today.
It's about 70 times.
No, it's over 100.
Is it over 100?
It's over 100 times. This exit will yield more money to the TCA investors to the investors in the deal than TCA has invested in to the TCA investors, because we've invested 100 million or more, to the TCA investors than all the investments that TCA has made up to date. Those are the kinds of home runs we're looking for. We've had 2 of them in the history of TCA. This one and one just before the 2000, .com crash. The third company is a company that's going on it's going through the IPO. It looks like the IPO will go next week. I don't know what the valuation is.
So let me ask a question about IPOs, because we know that SOX, 404, and a whole bunch of other factors have caused a lot of companies to decide not to IPO in the United States. Are we seeing any trend back to growth in the IPO?
My opinion, and JJ can give his. My opinion is that the IPO has nothing to do with regulatory. It's the fact that there's no market for it. Mm-hmm. It's again gets back to the risk averse concept. The company's got to be very, very strong and have a dominant position or a leading position in order to really get an IPO. The company that did the 100x is the largest purveyor of prepaid credit cards, primarily for those people without bank accounts, and they're sold all over the country. And they're white labeled with various names on them. But that was a need, and nobody's bigger. It's an easy one. But no entrepreneur should go into a business on the assumption that he's going to do an IPO. 99% of these deals that are successful get acquired. The 1% do the IPOs. And you got to be very lucky and in the right place, have the right investment bankers and the right advisors to do it.
So we have a few minutes left. Is there anybody in the audience that has a question that they would like to ask? Let's start right here.
I'd be curious in terms of
So the question is it better to syndicate investors versus working with a singular investor?
Absolutely, syndicate. The more money you can get, especially in this economy, if you can get money from multiple angel groups or angel investors or VCs and angels, whatever it is, just syndicate. Absolutely.
So,
Go ahead.
This is for pre-revenue companies. Is there any base formula which can be used as a guide, such as if successful, it might earn between 3 and 10 million in 5 years? So you take a point at the low end, 5 million, so it's going to have 5 million over this period. And then you have another equation, which is the probability of it being successful. And then, of course, what factors in is what kind of board you have and so on. And let's say there's a 20% probability of being successful reaching its goals. So that then you take the original 5 million and you take 20% of that and you come up with a base guide of 1 million. Now, this way of this base guide method of calculating doesn't factor in any of the other elements we discussed. So is that ever used, or can such an assumption or such a system be usable?
So for those that didn't hear it, basically what he's asking is there a foundational formula for future revenue to do valuation?
the answer from my perspective is it's been used, but it's really not valid because the discount factor. I mean, when you take the discount, you're not discounting to 80%. You're going to discount 98%. In other words, 98% of the company or 95% of the companies fail, period. So it's very, very rare that you'll find a company where we will do a valuation calculation based on some mathematical approach. That's why I said it's really a matter of negotiation at our level. VCs do a little bit better job of it, but they also do it at a later stage when they have a better sense of of where the company is.
Absolutely.
Right here?
So if you've organically grown your company and you have revenue, is it safe to say, let's look at comparables and what other people's earnings ratio versus valuation is? So XYZ company got funded, X amount of dollars at X valuation, you have this much revenue, or this much revenue, therefore we're worth this much, or is that just okay?
So for those watching, the question is, can you take a like organic company and compare the valuation that was provided them in an offering?
The organic role may be losing money hand over fist, but their revenue numbers and so on.
Okay.
At an early stage, it may not make. It doesn't make sense at an early stage. You can't compare.
Let's say $500,000 to $1 million in revenue.
Still pretty early.
It's very early, and they're different. Again, there are all sorts of different factors. I assume you're arguing that these are companies that are in the same business.
Right. Yeah. Of course.
But it's the quality of the management team, the quality of the board, the quality of the advisors, the nature of the customers,
Too many factors.
There's just too many factors that go into it to really be able to. I mean, you can argue it, and it has been done, and there is some value to doing it. But I don't think we even know it. So each one is what we call, it's his own negotiation.
There was a question in the back.
Yeah, well, for about 20 years, I had a company called Hood Financial Inc., and I raised about $120 million. And I've noticed, like, 8 magazines this month talk about it was like $107 trillion raised in 2000, and there was like $14 trillion raised in 2009. And I'm kind of wondering, where's all that? I don't know how long, TCN, how long you guys have been around. You said you raised $100 million. Over what period of time did you raise $100 million?
For different companies, we funded. We didn't raise. We funded over $100 million in 160 plus companies.
Over how many years?
Since 1997. And those companies have gotten in excess of $1 billion in follow-on financing from VCs, other angels. Most angels invest, most angel groups will invest in one company, probably between $300,000 and $800,000. Which is why the syndication becomes much more critical. And it's become more important, again, because of the recession. The angels are investing less. And we're doing a lot more syndication than we ever did. But I mean, 120 million you're in a totally different ballpark, and a totally different kind of economy and marketplace when you talk about that.
I mean, a few years ago, there was a company that TechCoastVenture invested more than 1.5 million in.
We raised $37 million just for 120% fatality right
all depends on where you were. You weren't.
Yeah.
Did you have no revenue?
Oh yeah, pre-revenue deal. Yeah, but we
When was this?
98, 99.
Yeah, but everybody was raising money back then.
Yeah, that was Alice in
I
Wonderland.
mean,
That's
when the
a very
dot-com
different
bust
job.
came,
Yeah, it's from 107 billion down to 14 trillion.
sure,
You know what I'm saying? So like,
and it's got the exact.
where's all the money being invested? It's not being invested that way anymore.
I don't know. I mean, it's gone somewhere. It may not be invested. A lot of it was lost.
Yeah,
A lot of wealth disruption in 2000.
Yeah, significant losses, yeah. That's actually a really important point you just made, in that if you divide up $100 million as a round number by $25,000 to $300,000, that's a whole lot of new ideas that got funded. Many people have a hard time with the concept that angel investors are just that. They're the angels that come from the sky and help you go to your next place. These are not big funded wallets that just make you rich. It's not the way it works.
if you really think about it, it's a lot of money.
Yeah.
$100 million.
That's my point.
For
If you-
a group that started with about 30, maybe 30 people, and now it's about 250 people, of which probably, when we do a deal, probably 10% invest in any one company of the 250.
That tells you it's a lot of money.
So it really becomes a lot of money when you look at it that way.
I would venture to guess that the education that's gained through TechCoast Venture Network and TechCoast Angels and other groups like that also is sort of immeasurable, because many of these people did go off and get funding. They just didn't happen to get it from these folks here. They got an education from them. They may have gotten some hard lessons, but ultimately these folks do work together. It is a very small community. Investors, believe it or not, there's not that many of them. Are there any more questions in the audience? This is an opportunity to talk to two folks that have done a lot of financing. All right, so let me ask you, at this point in the economy, and if you were given a deal right now, post-revenue, high consumer, do you want a company with a large piece of a narrow market, or do you want a company with a small piece of a very big market?
Very big market. It's always, we're looking for very big markets, because penetrating a market is very hard. So when you have a very big market, it's easy to penetrate a small piece of that market, which could mean a big portion, a big revenue.
So are there any trends that you're seeing in today that are getting funded? I mean, we hear biotech, we hear green tech, we hear.
Yeah,
What's popular?
I mean, well, it's hard to say with TechCoast Angels what's popular, because I don't.
We get everything.
We get everything, from high tech to consumer products, and indeed there are at least two consumer products deals in the house right now. I don't know whether they'll have enough traction to get funded, but there are. It's been all over the lot, and some have been successful and some haven't. The trend, though, in the general trend is toward things like clean tech, green, and everybody's trying to create an image that this company has some green component. I mean, it's
another
really
Alice in
funny.
Wonderland in my
Right.
mind, but
a lot of it is. A lot of it is Alice in Wonderland.
It's gonna blow up one day.
And ultimately, that'll be this fad. This fad will pass too.
Yes.
As every other one has. But if you have an idea,
The strong ones will survive.
right?
Yeah.
And the strong, and if you're strong, if your idea is strong, if you have a good, solid, market that's available to you, it doesn't matter where you are. It's you, the quality of the idea, and the quality of the commitment and team that you're doing.
So with the lack of consumer growth, would you prefer as investors to see business to business or consumer to business? Which type of category would you prefer in this market right now?
Answer that question.
Yeah, go ahead.
Well, I mean, I think it's the function of the deal.
It is.
If you had to choose, my gut tells me I would choose business to business because it's a little bit. You see,
It's easier to make deals.
Right. It's also easier to acquire customers. One of the big issues in any deal for an angel investor is what's going to be your cost of customer acquisition. How much is it going to cost you as an entrepreneur to acquire each of your customers? And that's a function of the space. It's a function of where you're going to market. It's a function of a lot of factors. But the lower your cost of customer acquisition, the more likely you are to get more customers for less. And therefore, it means that to us, you have at least a somewhat better chance to succeed.
So finding an ingenious way to get attention for yourself without spending money would be a really good way to increase your valuation, right?
Sure. Absolutely.
Yeah.
So it correlates to basically how easy can you get your customer.
Right.
So the easier you can get your customer, the better. The other thing I would like to say is that, when it comes business to business, maybe easier to get your customer or attention, but most of the time the consumer is a much bigger market than a business to business.
That's true. Consumer is a much bigger market.
Yeah, we've seen Apple has proven that, have they not? That's a little scary. Well, gentlemen, I really appreciate your taking the time. I'd like to give each one of you a minute or two to close out and give these folks the thoughts that have been running in your head, but I haven't allowed you to get out. So, Steve, why don't we start with you?
I mean, I think I've talked too much. All I want to say to entrepreneurs is I love entrepreneurs. I mean, I love the passion. I love the creativity. There are more ideas floating out there that you guys have than I've ever seen in my life, and there are more and more coming out all the time. And California is a particularly fertile ground for that process.
The sun.
So I just say, keep following your dream. Just do it. The old Nike motto, just do it. And good things are going to happen. And if you don't succeed one place, you'll succeed in another.
On the same thought here, I've been there so many times, and all it takes is persistence. It takes, you need to be very aware of your surroundings, of your competitors, of what's going on, and you need to know when to stop or when to continue. So you can't, you have a dream, you can't stop going after that dream. But if you see signs, then you need to understand that those signs are telling you to either stop or to keep going. But the persistence is taking risk and being persistent is an entrepreneur's, that's their trait.
And we're as bad as let me say one thing, Kevin. We're as bad as you guys are in that respect.
Yeah, we keep doing it.
I mean, no, I don't mean it even that way, JJ. We invest in companies that get in trouble. And what do? We put more money into them because, my God, we can't lose our investments. We got to put more money and lose more money. I mean, it's a vicious cycle. So don't feel bad if you're not successful. We're not really successful either. So
if you fall, just get up again, do it again.
Right.
Yeah.
You just. I mean, for us, we've just got to hit the big one like this 100x today, which makes up for anything you lose. And that's why we invest. At least some of us invest in a wide variety of companies.
I actually have a little Weeble, the thing you flick it in the head and it falls over and comes right back up. And I remind myself all the time.
Just don't give up. Don't give up.
Thank you, Steve Block and JJ Rishi. You guys want to give them a hand? And you've been watching Ion Business. My name is Kevin McDonald. You can watch us every Friday, 6 a.m. to 6 p.m. and 9 a.m. to 9 p.m. We are broadcasting from Kenobi, Martins, Olson, and Bear at the Tech Coast Venture Network Forum on how to increase your valuation, spending less money. Thank you for watching.